Consider the financial profile of a highly specialized medical professional. She has optimized her career for maximum earning potential, but she is now hitting a mathematical ceiling imposed by the tax code. Sarah operates as an orthopedic surgeon, earning $425,000 a year in active W-2 income. At this tier of compensation, she faces a combined federal and state tax bracket of 40%. To build wealth outside of medicine, she purchases a $450,000 short-term rental property. The property performs exactly as intended, generating $30,000 in positive net cash flow by the end of its first year of operation. This diagram shows Sarah's financial outcomes. Despite putting $30,000 of actual cash into her pocket, the property generates a six-figure paper loss of $123,846 on her tax return. This specific loss mathematically erases roughly $50,000 of her active W-2 tax liability. A legally compliant, cash flow positive asset should not logically produce a six-figure deduction that directly cancels out a surgeon's active salary. To understand how this functions without triggering an IRS audit, we must examine the specific regulatory exemption making it possible. The Internal Revenue Code is engineered to isolate high-earning professionals. The IRS actively restricts doctors, lawyers, and executives from buying side businesses simply to shelter their primary salaries from taxation. This restriction traces back to the Tax Reform Act of 1986. Congress designed this legislation specifically to stop wealthy professionals from using real estate as a tax shelter against their high incomes. The legislation introduced Section 469. Section 469 is a tax provision that automatically categorizes all rental real estate operations as passive activities, regardless of how much time the owner spends managing them. The consequence of this classification is absolute. Passive losses can only offset passive income. They are legally walled off from your active W-2 salary or your primary business revenue. Therefore, to replicate Sarah's tax outcome, an investor cannot operate a standard rental property. They must utilize a legally codified mechanism to break through the 1986 wall and forcefully reclassify their asset from passive to active. To bypass the Section 469 wall, investors rely on IRS Regulation Section 1.469-1T. This specific tax code outlines the strict criteria required to exclude an asset from being defined as a rental activity entirely. The code dictates that if the average period of customer use for a property is 7 days or less, the IRS ceases to view the property as a rental activity. You calculate the average by dividing total rented days by distinct bookings. 180 days across 45 bookings averages 4 days. You pass, but dropping to 20 bookings averages 9 days, and the IRS locks you behind the passive wall. The calculation relies strictly on occupied days. Vacant days do not factor into the denominator, meaning investors must actively monitor their booking links throughout the calendar year to protect their ratio. By successfully staying under the 7-day threshold, the property is legally treated as a commercial enterprise, like a hotel or a motel. This exempts it from the Section 469 barrier entirely. With the property classified as a business, the investor can generate the massive paper loss necessary for the deduction. They do this through cost segregation. Cost segregation is an engineering-based analysis that identifies which structural components of a property wear out faster than others. Ordinarily, the IRS forces owners to depreciate commercial real estate slowly over 39 years. Cost segregation identifies specific assets within the property that qualify for heavily accelerated timelines. The study slices the total purchase price into distinct buckets based on life expectancy. The foundation drops into the standard 39-year bucket. Interior components are dropped into an accelerated 5-year bucket. Exterior improvements are separated into a 15-year bucket. Once the property is segregated, the investor applies the catalyst found in the One Big Beautiful Bill, or OB3. Signed on July 4, 2025, this legislation restored top-tier depreciation benefits for real estate investors. This document outlines the TY 2025 real estate tax incentives. The legislation authorizes 100% bonus depreciation for qualifying properties acquired and placed in service on or after January 20, 2025. The timing requirement is absolute. Properties placed in service between January 1st and January 19th are capped at a 40% phase-out rate. Those placed in service on or after the 20th secure the full 100% deduction. Applying this to Sarah's segregated assets, she instantly deducts $145,000 of the property's basis in year 1. This massive paper deduction eclipses her rental revenue entirely. The combination of engineering-backed cost segregation and 100% bonus depreciation creates a tax shield that vastly outweighs the actual cash the property produces. This deduction is only valid if the taxpayer meets the final hurdle. They must prove material participation. Material participation is the IRS framework that measures the exact amount of time an owner spends working on a business to determine if they are an active operator. The most common standard short-term rental owners use is Test 3. To pass Test 3, the owner must participate for at least 100 hours during the tax year, and they must spend more time on the activity than any other individual. Sarah logs 165 hours managing the property. Her cleaning company logs 140 hours. Because Sarah's hours outnumber the cleaning crews, she passes. But if your cleaners or property manager exceeds your time and hits 200 hours, you instantly fail. The IRS also scrutinizes the type of work being done. They separate operator hours, like communicating with guests or repairing a sink, from investor hours, like reviewing financial statements or organizing receipts. Investor hours are routinely thrown out during an audit. This scrutiny extends to travel. A 2020 tax court decision involving an investor named Mr. Lucero established a strict precedent regarding drive time. The court determined that driving to your rental property is the equivalent of a personal commute to a job. The IRS discards those hours unless the travel is explicitly integral to the physical work performed on site. Material participation is the central requirement in an audit. If you fail to prove your hours, the active classification collapses, and your massive paper losses are locked back behind the passive activity wall. By satisfying the 7-day rule, maximizing bonus depreciation, and proving material participation, her paper loss overlaps her W-2 block. The tax code multiplies the loss by her bracket, yielding nearly $50,000 of cash saved, completely shielding her salary. However, securing this outcome in an audit requires exact physical proof. The taxpayer must maintain a contemporaneous time log. A contemporaneous time log is an administrative record containing the date, duration, and task description, created at the exact time the work actually occurs. Sarah's ability to keep that $50,000 tax win relies entirely on her ability to produce this specific spreadsheet the moment an IRS examiner requests it. Auditors do not simply take your word for it. The IRS routinely requests the digital files of time logs to check the metadata, actively searching for evidence that the document was created retroactively. Reconstructing your hours from memory weeks after the fact is considered fraud, leading to criminal charges rather than just tax penalties. Furthermore, investors must strictly adhere to the legislative timeline. Securing the 100% deduction requires the property to be acquired and fully placed in service on or after January 20, 2025. The short-term rental tax exemption is a legally codified reward for active business operators. Qualifying for these deductions requires the same rigor in administrative documentation as the property acquisition itself.